welcome again, everyone. Good evening, and thank you for joining the Center on Global Energy Policy for today's conversation. My name is Valeria Robecco, and I'm the president of the United Nations Correspondent Association. Today, we are going to discuss the role of raw carbon hydrogen in meeting the world's climate goals and energy needs with a very distinguished panel. Let me quickly say that this event is open to the press and on record, and it is being webcast live, and the full video will be available in the coming days. Some housekeeping instructions for those of you joining us via Zoom. You can submit a question for the panelists at any time by clicking on a Q&A button on the bottom of your screen. I now have the pleasure of introducing the Consul General of Italy in New York, Fabrizio De Michele, who will share remarks before we welcome our panel. Please, Consul General, the floor is yours.
Thank you, Valeria. Thank you all. Good afternoon, actually, to all and to the speakers. It's a pleasure and a privilege to open this roundtable at the Columbia University. Can you hear me? Please. I was saying it's a pleasure and a privilege to open this roundtable at the Columbia University with so many authoritative speakers. And it's frankly hard to find nowadays a topic more pressing and relevant than the one we are discussing today, the energy transition. We just came out of COP26, whose outcome, despite some expected shortfalls, can still be judged a positive one. For sure, climate change and the need for governments' mitigation policies are at the center of the public discourse and awareness, probably like never before. Moreover, the private sector at worldwide level is taking unprecedented commitment in this regard, including very meaningful. Is this working? It doesn't look like it's working. Can you hear me? I can scream, no problem. I'm almost finished. I'm almost done. So maybe I can use both.
Exactly.
As you might know, Italy, through its G20 presidency and its co-chairmanship of COP26, together with the UK, has given its own contribution to the whole process. In this regard, I think it's worth recalling that Italy is one of the world leaders as far as green economy is concerned. We are the first in Europe for share renewable energy in the GDP, and first in terms of rate of circular economy. We are second for efficient use of raw materials and for energy consumptions per unit of product. Italy is also the second country in the world for export of green products. Why I'm recalling all of this? Because I think it might offer some background to the fact that one big and consolidated, I'm trying everything here. I just wonder, is anybody hearing me? What I said so far?
Yeah, we are.
Good to know. It's reassuring. Yeah. So the question here, why I was recalling all of this? It's just because it might offer some background to the fact that one big and internationally consolidated Italian company, Snam, traditionally dealing with methane gas and energy infrastructure, is becoming a world leader in promoting clean energy, notably green hydrogen, in view of a transition to net zero emissions. In this respect, we need actually to acknowledge the personal vision and commitment of Mr. Marco Alverà, CEO of Snam, from whom we hear shortly. I really wish to thank the Columbia University and all the speakers. Since this afternoon, we'll have the chance to tackle the question on energy transition under very different angles and perspectives. And we really look forward to that. Thank you.
Thank you so much. It is indeed really hard to find a more pressing and crucial topic than the one we're discussing here today. So without further ado, let me introduce our esteemed panelist, Marco Alverà, CEO of Snam since 2016. Marco has 20 years of experience in Italy's most prominent energy companies. He began his career at Goldman Sachs in London, and in 2002, he joined Enel as Director of Group Corporate Strategy. In 2004, he became Chief Financial Officer of Wind Telecom, and in 2005, moved to Eni, where he worked for more than 10 years. He wrote 2 books on hydrogen, Generation H on hydrogen's potential as a clean energy resource, and the last one, Hydrogen Revolution, a blueprint for the future of clean energy. Dr. Giulio Friedman, Senior Research Scholar at the Center on Global Energy Policy at Columbia University, SIPA. He recently served as Principal Deputy Assistant Secretary for the Office of Fossil Energy at the Department of Energy. For 15 years, he has held positions at Lawrence Livermore National Laboratory, and he worked for 5 years as a senior research scientist at ExxonMobil. Dr. Friedman is one of the most widely known and authoritative experts in the US on carbon removal, CO2 conversion and use, hydrogen, industrial decarbonization, carbon capture, and sequestration. In addition to close partnership with many private companies and NGOs, he has worked with US State Department, the US Environmental Protection Agency, and the US Treasury. Amy Myers-Jaffe, research professor and managing director of the Climate Policy Lab, the Fletcher School at Tufts University. A leading expert on global energy policy and sustainability, she has taught energy policy, business, and sustainability courses at Rice University, University of California, Davis, and Yale University. Jaffe serves on the Leadership Council of the U.S. Association of Energy Economics and holds a Senior Fellow Award from that organization for her career contributions to the field of energy economics. She is also a member of the Global Future Council on Net Zero Transition and the World Economic Forum in Davos. And last but not least, Mark Gallogly, CEO and co-founder of the Three Cairns Group. He is co-founder of Three Cairns Group, a social impact firm focused on climate through venture investing, philanthropy, and public policy. He recently served at the US Department of State as an expert senior advisor to Special Presidential Envoy for Climate, John Kerry. Under the Obama administration, he served on 2 presidential advisory councils, and he co-founded and served as managing principal of the private investment firm Centerbridge Partners. Before, he spent 16 years at Blackstone. So now I have the pleasure to give the floor to our panelists for some opening remarks. Let's start with Marco Alverà. Marco, please, the floor is yours.
Thank you. Thank you very much. Thank you, Giulio, and all our friends at SIPA in Colombia for organizing this. Thanks to my team. It's great to be back here. I will start by spinning some positive energy into the energy transition debate. I think Glasgow was a great success. Some of the headlines in the media were not so positive, but I think it was a great success for several reasons. First, we now have 90% of emissions in countries that are committed to net zero. And that makes a whole of a difference. It's a difference between saying, let's just reduce emissions and having a plan that's actionable, measurable, with targets. Having net zero forces people to think about the harder questions, the hard to abate sectors. This led to an unprecedented convergence in what we have to do. If you look at what most of the universities are saying, what most of the banks are saying, what most of the studies and the IEAs and the companies, there's now more or less a consensus on what we have to do. Electricity is going to increase from 20 to about 50%. Some people say 60, some people say 45, but more or less there's convergence there. There's also convergence that hydrogen costs are going to come down a lot and will make up a big part of that remaining 50%, maybe 20, maybe 30, maybe 35, big volumes. The ranges out there are from 500 million tons to 1.5 billion tons per annum. The third consensus is that we need CCS. Some people really dislike CCS, but it's a question that we need to address and make people understand that it's a necessary way of staying below 1.5. I also think there's now finally consensus that we need and we can stay below 1.5, and that every basis point above that really does matter. I think there's a sense of urgency. I think 1.5 degrees is on a lifeline, to quote some politicians. And I think COP27 is where we can make it or break it. So I hope a lot of progress happens between now and the months that are left before COP27, really to take 1.5 degrees off the life support and to make it grow as a real opportunity. Why I think the convergence is there is because we have the cost trajectory to make renewable energy and renewable molecules much cheaper than today's fossil energies. And that's really the only way we can get China and India to phase down and then phase out coal. Now, how we get there is the purpose of the book that you have on the chair. We want to get there by focusing on the supply side, by scaling up electrolyzer technologies. And we are convinced, and we created a green hydrogen catapult, Snam, Iberdrola, Ørsted, Yara, Envision, Aquapower, Fortescue, some 7 or 8 of the world's biggest developers of renewable projects. We think we can get to $2 a kilo, which is $50 per megawatt hour in the next 5 years. Why is that number important? Because that's more or less oil parity. An effort that I think we should all do, and especially people in academia who can really push the narrative into the mainstream. We need to get the energy world to move to megawatt hours, because if we continue to work in tons and MCFs and British thermal units and million cubic meters and pence per therm in gallons, liters, we just won't understand how to compare the different sources. So we need to move everything to dollars or euros per megawatt hour. And then you really see what's happening. The power, the Columbia University is paying the utilities about 300 euros per megawatt hour. Hydrogen was 1,000. The only page that really matters in the book is page 229, where you have this chart that says, we were at 1,000, then we came to 600. Now we're at 100 today. We can get it to 50. The DOE Earthshot is about getting it to 25, which is $1 a kilo. That's when you start competing with coal. And the Bloomberg New Energy Finance, the BNEF, they now reckon we can get to $0.50 a kilo, which is about $12 a megawatt hour. So I will finish here, but just leave you with this thought. We have the price you're paying now for electricity at about 300 or 280, and you can get green hydrogen produced not too far away. In 5 years at 50, before 10 years at 25, and then at 15. So the option is there. We just need to scale it up. What was really missing from COP were the projects. If anything happened at COP, there was a big divide between the ambition and the action. And so this year, hopefully, the action will start. We have a time frame that we need to get projects built by 2027. That's to hit the 2030 targets, which are a key part of getting to net zero by 2050. So what happens in the next year is key. What happens on the ground before 2027 is also key. The incentives are there. We announced as Snam a $25 billion investment program to deliver on some of these projects. Thank you.
Thank you so much. We really need some good vibe and positivity on this matter, I guess. So now, Giulio Friedman, please, the floor is yours, Giulio.
Thank you very much. And thank you so much, Marco, for coming here. And thank you for this remarkable book. It's really something else. I was delighted to have an advanced copy. I was delighted to read it. It's just beautiful, beautiful, good news. I like to start talks like this with bad news. And we are still at 51 billion tons of greenhouse gas emissions a year, and we should get to zero in about 30 years. And that's very, very hard. Zero is difficult mathematics. It means if you emit anywhere, you must unemit an equal amount somewhere else. Zero means there's no room to hide. Everything, it's not just the cars we drive, but the roads we drive on must be net zero emissions. The schools, the hospitals, everything, the steel factories, everything's got to be zero. And that's extremely, extremely hard to do. The breakdown that Marco laid out is, I think, pretty accurate. Something like 40 or 50% electrification for energy services, 20 or 30% hydrogen, 20% to 10% fossil with CCS, a little bit of biofuels and some CO2 removal. That's the arithmetic. The thing that is remarkable about the moment, and I like to pivot to the positive news around this, is that the pace at which we are innovating is extraordinary. And the basket of technologies that we have today is close to sufficient. We have essentially most of the technical kit we need. A lot of it is not deployed at scale. The deployment at scale part is work. You need finance, you need market aligning policies, you need factories, you need human capital. You need these things to actually deploy at the scales we need to deploy. But we have electrolyzers. They are made. There are companies that make them. And there's now a race to make gigafactories of these things and to drop the prices. That's good. That's excellent news. We also have devices that now turn electricity and carbon dioxide into jet fuel. That's nice. Is that commercial yet? No. Can we make it commercial? Can we drop the prices through things like investment and innovation and so forth? Yes. Do we still need the human capital? Yes. Do we need the market aligning policies? Yes. The thing I want to leave you with is a sense of optimism that we can do this, and at the same time, a cold-hearted, clear-eyed vision of where it's going to be tough. Because if we don't tackle the tough stuff, we will fail, and we don't have a lot of time. One of those places where we are likely to fail is infrastructure. We are going to need hydrogen pipelines. We're going to need CO2 pipelines. We are going to need new ports. We are going to need to triple or quintuple the power grid to get to where we need to go. That is a lot of consensus building. That is a lot of investment that investors will want to get a return on. These things have to be conscienced in that way. Whether I am optimistic, though, or pessimistic is beside the point. The work looks the same. And we now have the technologies we need and the work scope in place to imagine how to deliver the future we wish. Thank you.
Thank you so much. Thank you so much. Now, Amy Myers Jaffe, the floor is yours.
Okay, so I'm going to be a little bit more commercial in my presentation. Of course, agree with what Marco said, but wanted to add something to it. So I think there's this perception, which is probably accurate, that Europe is sort of ahead, has a much more featured strategy, is putting together the legal frameworks to put these things in place, has the carbon market as a support. And so that leaves the impression that the Biden administration is facing this headwind because it's very hard to get things past the Congress and nothing is happening here. But that is actually not correct. So I recently did a study together with Gas Technology Institute, which some of you may know is a premier sort of not-for-profit think tank that does technology development and sort of a good relationship with DOE and some of the labs. And one of the things we looked at, part of my job, was to survey the US natural gas industry to see where they were on hydrogen. And in particular, we were interested in, were they experimenting with hydrogen and natural gas blending? Were they thinking about hydrogen as a business? And where were they on that process? And we were kind of expecting in our heads that we would survey 20 or 25 companies, and we would hear that one or two of them were thinking about hydrogen. And I am pleased to say that almost every single company I talked to at the most senior level and on the technical level, they were all looking at hydrogen. There are a number of US companies that are already doing pilot projects in blending hydrogen into their existing infrastructure. One of the executives taught me a new word, future-proofing. He said that he didn't want me speaking about stranded assets anymore, that we need to be thinking about making our assets a benefit for the energy transition. How do we take assets we already have, and instead of having to build out, like Julio said, billions of dollars worth of infrastructure, how do we convert the infrastructure we already have to contribute to the transition? And we've already talked about net zero. So I always like to remind people with net zero, because secretly people are thinking in the back of their mind that carbon neutrality and net zero are the same thing, but of course they are not. And so we're not talking about somebody blending hydrogen into their business or putting it into the utility and green hydrogen or whatever and cleaning up and selling that offset to somebody else. What we're actually talking about are companies making removals of carbon so that the abatements that they cannot do that are absolutely impossible to remove or very, very expensive to remove can be handled through negative emissions. So what I found was that there were a number of companies, either they were looking at the corridors that might play into the California carbon market and the existence of existing projects in California, either for hydrogen into the transportation network or hydrogen into the utility network. Dominion has a particularly progressive project where they're working with a utility in Utah that supplies electricity to the city of Los Angeles in converting that plant to be 30% green hydrogen. But you had other companies, and really, I think, to Julio's point, you get to the technical challenge because, people have done the experiments. Can you be 10% hydrogen without having to change your infrastructure? Was it 20%? And optimistic case. And it was very varied experience because the condition of people's equipment, and that's not just the steel in the pipeline, but also the compressing stations and so forth. I found ranges of companies that had customers that were willing to take 30% because their equipment in their end use could accommodate a 30% blend, that could only get to 3% because their own system couldn't go beyond 3%, to other companies that are really making a lot of progress. So my story is that I agree with Marco's statements that the numbers for green hydrogen in terms of scale up look like it could be very commercial in a very short time frame. And therefore, some businesses are going to have to reevaluate how competitive gray hydrogen or blue hydrogen needs to be able to compete. And but that we're already begun the process in the United States, and the Biden administration's infrastructure allocation to 4 hydrogen hubs is the way to go, because as I mentioned, there's no way to do system-wide blending because the conditions and the age of the natural gas infrastructure in the United States is quite varied. And so this idea of having different geographic hubs is going to be the way to go in the United States and to build out from that. So clearly you could have one hub that anchors around what California is already doing with Semper and so forth. I think there's an aspiration, as conservative as they are, to have a hub somewhere on the existing hydrogen infrastructure in the Southwest. So Air Products, bless them for their recent announcement that they're going to try to expand that hydrogen hub to Louisiana and not have it be limited just to Houston area. And then we've looked at the potential to take wind from the Midwest and pair it with heavy industrial use and look at the potential for some kind of hub in the Midwest. So those are 3 key areas. I know Massachusetts, now I'm sitting at Tufts, would like to see green hydrogen come from the development of deep water wind, but New England would have to come up with a plan for the end use.
Thank you so much. And now let me welcome Mark Gallogly. Please, the floor is yours for some opening remarks.
Hi, everybody. It's fun to be at SEPA. It's great to be at Columbia, the climate school, the whole energy center. There's just so much going on here. It's fun to be here. I guess I would just add one thing if I could. So big picture, net zero drives a lot. If you believe net zero is happening, that drives a lot of decision making, even if it's not official. Businesses have now gotten it in their head that they need to deal with that. And the pathways around dealing with that are being refined. Whether they're fixed fast enough will determine whether, whether this works. I think Marco's statement that energy, 50% will be electricity, 20 to 30% hydrogen, knock on wood, that'll be true. And CCS needs to work. What else needs to work? And I think that one of the major things, Julio could give us a long list, but one of the major things that needs to work is to reimagine how finance works. Today, whether you read the IEA or McKinsey or Goldman or Julio, more or less people say we need to figure out a way to think about the aggregate energy system today of round numbers, $1.5 trillion, scaling up over the next 30 years to $5 trillion, an incremental 3-ish to 3.5 trillion a year for 30 years. When you think about these numbers, they're so damn large. What do they really mean? Big picture, it's about $100 trillion. The challenge of that $100 trillion includes that 2 out of every $3 of it is going to be spent in the developing world. So 2 out of every $3. And so when people say, when leaders say the private sector can fix this problem, you really have to think about that. The private sector does not really like lending to the developing world very much money. It's pretty well proven that. And it'll lend it at scale for specific things where it's going to get paid back. So for example, this year in India to date, around $5 billion has been raised in the US dollar market for solar and wind projects by 3 major solar and wind companies. The CEO, one of them, is a Columbia grad, proud Columbia grad, okay, running this Indian wind business. $5 billion is a lot of money, but it's really popcorn stand money relative to what India needs. And so where is this money going to come from? Where is 2 out of every 3 of $100 trillion going to come from? Joe Biden just went like this. He said, oh, I will double. The United States will double our commitment to annual renewable energy globally. So we went from round numbers, 2.5 billion to about 5 billion. And then he doubled it again. And the math turned out to be 11.4 billion. And that's what we announced at COP. 11.4 billion sounds like a lot of money. It's a really small amount of money on a relative need basis to redo the entire global energy stack. To put it in context, the United States today is about maybe 13% or so of global emissions, round numbers, okay? Historically, we've produced 25% of every little bit of GHG up in the atmosphere, but we're about 13. What will we be for the next 30 years? Round numbers, 5%. So the US is going to be 5% of global emissions. Not very much, really, in the context of what we've been, but the developing world, Nigeria, South Africa, Indonesia, Vietnam, India, obviously China, their emissions hugely increase. China will take care of itself financially, but the rest of the world, how are we going to finance this? I'd end with 3 things. The money either comes from the West, like taxpayers, but we're not very good at doing that. We don't really like to do that much. It's pretty well proven. We don't even want to invest in vaccines, and therefore people get sick in other places and then come back here and get us sick. So, and that's small dollars, really, really small. So that's a question, are we going to do that? If not that, then what? Maybe the World Bank? The World Bank lends to countries. The World Bank lends to countries. It takes no risk. It's the first dollar repaid. The World Bank gets paid first. They're not taking risks. They're not even a bank, really. They are a lender to sovereigns who gets paid back first. Therefore, the word risk doesn't enter their calculus. So it's not going to be the World Bank unless we change the charter of the World Bank. The IMF, maybe. One glimmer is that the globe has endured 2 major catastrophes in the last 14 years, COVID and the 2008 crisis. The global central banks put out $25 trillion during that period in the concept of quantitative easing. That was an inconceivable view of the world in 2007. That would not have been possible, impossible, but it happened, okay? I think that someone needs to reimagine how we think about global finance in this problem. And it needs to really be thought of as a plan B if the net zero initiative that we're discussing today doesn't work. And even if it does work, we need to think much more creatively about how we finance each of the activities that are being discussed today. Thank you.
Thank you so much. Again, for those are watching online, my name is Valeria Robecco, and I'm here with Marco Alverà, CEO of Snam, Fabrizio Di Michele, Consul General of Italy in New York, Dr. Giulio Friedman, Senior Research Scholar, Center on Global Energy Policy at Columbia University SIPA, Amy Myers Jaffe, Managing Director of the Climate Lab, the Fletcher School, Tufts University, and Mark Gallogly, co-founder, Cairns Group. So we will now move to moderated discussion, and we will open up a question from the audience in a bit. Let me repeat that for those of you joining us via Zoom, you can submit question for the panelists at any time by clicking on a Q&A button at the bottom on your screen. I kindly ask our panelists to be as concise as possible so we have more space for questions. I'm sure there will be many. I'm surely have many for all of you. So let me start asking a couple of questions to Marco, and if somebody else has something to add, please feel free to jump in. During COP26, the Special Envoy for Climate, John Kerry, who also publicly endorsed your book, said the way that leads us to a clean future is made of hydrogen, and it passes through Italy. Green hydrogen is by many considered the definitive solution to the climate emergency. Is this a realistic project? And what timeline do you see to start to fully implement the hydrogen in Italy and above all elsewhere?
Thank you, Valeria. I'll try to be brief. I could go on for a couple of days on this. But what we announced yesterday is a $25 billion plan for Snam. We also announced the acquisition of a pipeline going into Tunisia and Algeria. So I think Europe can step in and finance a lot of at least the North African development opportunities. And this is in the order of hundreds of billions of euros of potential infrastructure that has to be built, can be built in North Africa, countries like Morocco, Tunisia, Algeria, Libya, Egypt. These countries can then supply Europe with very cheap hydrogen. Europe today is paying natural gas we talked about megawatt hours, $100 a megawatt hour. So it's at a par today with natural gas. But what North Africa can also do, going to Mark Gallogly's point on Nigeria, is North Africa, because it has more land and desert land and a lot of sun, those same countries could export to sub-Saharan Africa, because we have 2 billion new people coming to sub-Saharan Africa. And so 70% of every child born between now and 2050 is going to be in sub-Saharan Africa. 5 of the world's top 10 countries are going to be in Africa. And Nigeria is going to overtake China in terms of population. So we really need to get Nigeria right. And I think doing a lot of development in the Middle East and North Africa can supply these countries without deforestation, which is another risk of developing new infrastructure.
Thank you so much. And let's talk about a little bit more of what Snam is doing. And let's go then to your new book, which is the second one about hydrogen, and how the market has changed between the two books.
I have to keep writing them because, as Julia knows, the curves keep falling. And so the last book, which came out a week ago, is already obsolete because of Bloomberg's new $0.50 longer term target. So we'll continue to chase the curve. But really what we're doing to accelerate this and to deliver it, to Julia's point, is about building the factories. So we're a pipeline company, but we're integrating ourselves vertically to build the factories. We are working to attract US dollar raised finance into projects that we then go and develop in the Middle East and in Africa. So that's really what we're trying to do, to develop the projects, put our capital, put our technology, but because we want to punch above our weight, partner with private equity, infrastructure funds, pension funds, so that instead of doing one $10 billion project, we can do 10 $1 billion equity checks and help develop greater projects.
I have a very last one. Very often companies have resisted investing in sustainability because they saw it as a cost, while now they also see it as a benefit. So is it a generalized change of pace, or one that concerns only certain realities? And do you think, if so, it will last?
We touched on this earlier. There's going to be a big human talent crunch and shortfall. Especially the younger generations will only go to companies that have a good ESG performance. I'm on the board of S&P Global. We will soon be issuing ESG ratings. And so the equity markets with $130 trillion of GFANS, the Glasgow Alliance for Sustainable Finance, they will only want to invest in companies that have a high ESG score. So companies that don't perform well on ESG are just going to lose out on the talent, higher cost of capital, greater difficulty in dealing with the stakeholders. So it's a must, but I would add that because we can deliver a lot of this sustainable clean energy cheaper than today's energy, the first mover also has a big arbitrage, and this is really the best business opportunity that I've ever seen.
So the young generation can be once more a game changer, right?
Absolutely. That's why I also have a fourth book, which is written for the 10-year-olds on how to bring all this narrative into the lower schools, because that's where we have to start getting a positive message. So they stop protesting against everything and they start protesting for something, because that's where you lead to action, because fear generates paralysis, but hope generates a very positive action.
Thank you so much, Marco. And Giulio, let me turn to you. You have just been in Glasgow for COP26. So what is the value of a summit like COP26 and like the more restricted formula of the G20, given the differences that stand out between countries, for example, like such as India and China? Do you think that this kind of format can be improved, or it must be changed, or is working in any way as it is?
So thank you. This is one of my favorite questions. The old system of negotiations that were represented by the Kyoto Protocol is what I called a firing squad in a circle. It is not built for productivity. It is impossible to actuate. Nations hate it, and it doesn't go anywhere. The Paris Agreement is a completely different sensibility. Think about the Paris Agreement from COP21 as a weight loss club. Everybody raises their hands. I'm going to lose 5 pounds. And as a consequence, what matters is actually the national contribution. And in fact, the commitment is by nations. It's a nationally determined contribution. Every country brings what they can. It's a giant potluck, and everybody comes together. The thing that's the value of COP26 then is no longer in the climate negotiation itself. That remains important. Things like Article 6, subsection 2 and subsection 4 matter still. But the action is now in the nations themselves. And so the value of COP becomes a forcing function. It's actually good old-fashioned peer pressure. Everyone comes to the party. Are you going to come empty-handed, or are you going to bring something? Did you lose the weight or not? And everyone gets on the scale in 2 years. The first official stock take is at COP28. That will be in Abu Dhabi, and people have better lost weight or else they're going to look bad. And so this peer pressure sensibility has actually been extremely useful. And we saw it at COP26 right beforehand. India declares net zero by 2070. Saudi Arabia declares net zero by 2060. And that commitment reflects the desire of nations to be part of a club. Things like the First Mover Alliance that was announced by Secretary Kerry, I guess Special Envoy Kerry now, is another forcing function. Companies are selecting to be proactive because they think they'll get market share. That creates a virtuous cycle. You're going to have sectors and trades that are coming together to say, I want low carbon steel, I want low carbon aluminum, I want that to be my product line, right? And in fact, if you double the cost of steel to make it clean, it increases the cost of a car 1%. The finished good cost does not go up much. So these things can be come into the world in a useful way. So COP26 becomes very helpful, and so does the G20 after it, and so does the Clean Energy Ministerial after it, and so does Davos, and so does the next COP. We put up the pressure every year. Climate Week is followed by the COP. COP is followed by Davos. Davos is followed by the next event. And that ambition is what the Paris Agreement was about. So I left the COP optimistic. The last 4, I was very disappointed. This one, I left very pleased.
So let's talk about the UN. What role the United Nations do you think can play in the process of ecological and energy transition, given the difference that have emerged and partially have derailed the good intention of COP26?
So there's 3 things the UN already does that are very important. One of them is they actually bring together groups that matter to make commitments. One example of this is actually the UN Asset Owners Alliance. The UN Asset Owners Alliance has 10 trillion $10 trillion of assets under management, and they have made a net zero commitment. So the UN becomes a platform for action like that. That's very good. Another thing the UN can do more of, and already does today, is build human capital. For me, this is the thing I wake up at night screaming about. When I have a nightmare, it's because there's not going to be enough people to do the job. I believe what Marco said, it's going to come down to projects. The scarcest resource I've found out there is a good project manager. They are very hard people to hire. They are very hard people to train. If you don't have enough project managers, money will be wasted, projects will fail, people will get disappointed. So we need to build this human capital enterprise. The UN can help build human capital capacity everywhere in the world. They can be a platform to do that, and they already do some of that. The third thing the UN can do, they do this in some circumstances like the Montreal Protocol, but I hope they do more of this actually, is to set standards. So clean hydrogen is going to be very important in the world. Excellent. What is the appropriate standard for clean hydrogen? If green hydrogen comes from the grid in a country like Europe, it's not that clean, actually. It actually needs to be very low carbon hydrogen. You need dedicated renewable resources, like the kind that Marco's going to build in North Africa, or you need a dedicated nuclear power plant, or you need something like it. We're seeing plants like the NEOM project in Saudi Arabia, or the Asian Renewable Energy Hub in West Australia. They are moving forward with these very clean products, but the UN can be the standard setting organization that can help contribute to that. So that's higher than the the EU taxonomy. That's higher than any one market standard. And they can bring together groups like the IMO, which is a UN organization, and ICAO, which is a UN organization, and set these standards so that the market knows what to do.
Thank you so much. Amy, electricity costs are skyrocketing in Europe, and US gas prices have more than doubled. So the effects of these rising prices and energy shortages are rippling up across the world. Let's try to understand how the transition to cleaner energy can help to stabilize energy prices and prevent shortages in the future. But first, can you explain us how we got there, and if transitioning to renewable energy sources help us avoid similar situations in the future?
Okay, so we did have some intermittency in renewables this summer. We had some drought in China, and we had some wind intermittency in Europe. But that doesn't really explain what's actually happening, in my opinion, in global energy markets. Referencing my first book, not my second book, Oil, Dollar, Debt, and Crisis, The Global Curse of Black Gold, I've been tracking the oil and gas commodity cycle for 30 years. And it's shortened. So in other words, we used to have a cycle where, the economy would grow. 2006, people said was a growth-led rally in the price of oil, with the growth in China and Asia. And then, companies would have to invest, and it would take 5 years or 10 years for the oil production to come online or new LNG to come online. And sometimes there'd be delays with these mega projects, which we can not name any names, but you can think of some big companies whose board has had some replacement. And the bottom line is there's a lot of failures in the mega project world. And then what happened? We went to shorter cycle resource. So first we went to shale, which turned out to be shorter cycle, but then the majors themselves and other companies themselves realized that with the energy transition coming, maybe keeping legacy assets that were satellite fields off the books didn't make sense. Maybe we should be producing those assets we have that are near infrastructure. And so when we get a price response, the ability to respond with production shortened. Now, fast forward to like this unbelievable event of COVID. So imagine the cycle I'm describing, which happened in 2014 and 2015 on steroids, because demand collapsed in 1 year immensely. And so drilling had to stop immensely because there was no place to put the stuff. So now fast forward to now, normally people make predictions that the US economy could grow in a good year, 2%. an unbelievable year, 3%. Well, we've seen something like 5 or 6% growth in the United States, and we've seen, thankfully, hopefully more sustained recovery in other parts of the world. And so the cycle was like a steroidal produced cycle where we had this unbelievable collapse, much bigger than we've seen before. And then the recovery was faster than normally we would have respect to do. And therefore, the system itself couldn't adjust. Now, it might have been okay, because honestly, despite what everybody says, demand is not back to where it was, if you really look hard and cold at the numbers, right? But it gave an opportunity for a group of countries to exploit a hole in the market and manipulate the market by underselling the amount of oil they have available, or in the case of gas, much more. And we're seeing the result today. So we can talk about what would be the motivation of a country that has enough oil to put it in the market, or has enough natural gas to put it in the market and chooses not to. What would be their motivation? Well, if you look at their positions at Glasgow, you don't have to look much farther than that. You would definitely want to slow down the energy transition. And you might hope that making energy prices very high would toss out governments, right? And there have been times in history, I won't name any names, where we've all commented that a certain country, like the President of the United States, so we put that country, help bring gasoline prices down to make that president, look more appealing to the American public. Well, if I say we're doing the opposite in today's world, where we now have a different way of thinking about dis and misinformation, it looks a little more hostile. If I were to discuss whether or not a country would bring up the price of gasoline to hurt President Biden. So what was the response? I think the president, at least from my perspective, and I think some of our allies feel the same way because they've responded together with that, is to deal with the short-term problem as a very short-term problem and see what may. SPR, in the United States, we have all these things we can do through management, through DOE leadership and other kinds of variables we can do, whether it's waiving the Jones Act or doing other things to remove bottlenecks for product movements in the United States. We need to remember that the United States exports 5.5 million barrels a day of refined product. So there is no shortage of products in the United States. The president could wake up in the morning, see there's a national emergency, and say some of those products have to stay inside our border, right? So that's problem number one. That has nothing to do with the energy transition. Now, it's true, and has already been alluded to, that if you're a bank today and you lent money to an American oil company or some other oil company sometime in this period where prices were volatile, you probably lost a lot of money. And if you put that money into renewable energy, so if you were a private equity firm and you sold that to a pension fund, you gave that pension fund something between a -3% IRR return on that investment to -12%. But if you put that money at the same period of time into renewable energy, you probably gave them a 7 to 10% return on their investment. And we can all talk about how much money you would have made if you bought Tesla stock at the low. So now we're facing this situation where we have to first manage the short-term problem of energy prices for the average consumer, whether that's someone in Europe or whether that's here in the United States or in low-income global South, where rising fuel costs can be devastating to both the economy and government balances. And I think we do a good job when we isolate producers who do not take the long view in terms of their responsibilities for the recovery post-COVID. So that's sort of my view. I don't think unfortunately, I don't think the energy transition is at pace fast enough to even matter right now to oil prices. I mean, maybe if you're trading a 20-year strip derivative or something, but if you're trading this year, not a factor yet. But, and this is the but, maybe the United States has done these oil producers a favor, because if the oil price went to $200 next year, how much faster would we have transitioned? I suspect that the premise that high energy costs meant that people would go to Glasgow uncommitted, and that it would convince Snam that they didn't want to do hydrogen anymore. My contention would be, you know, you're going to give me $200 oil, all the more reason for Snam to accelerate. Every pension fund around the world is going to be throwing dollars at all these projects, even more, because the oil price is high, and it's not going to bring a lot of money back into oil. They'll bring some money back into oil, but there is this long-term trajectory. And the key here is on the energy transition is it doesn't matter. So people are not analyzing this correctly. It doesn't matter whether the oil supply will or won't be there in 2023. That is not the right question. You know, the banks won't give somebody money or this or that, we're going to have a supply hole and all. That's not the question. The question is, post-Glasgow, how committed are governments to lowering demand for oil? What actions are we going to take to lower demand for oil so that if certain countries don't want to put more oil in the market, we don't care because we've eliminated the demand for that oil? Because you know what? We don't have to wait and figure out what cars we would drive. We don't have to wait and figure out that we could go to e-commerce and that's, you know, 20% or 30% more fuel efficient than all of us driving to the store, right? We know what we would do. So we should take that action.
Thank you so much. You actually answered already my second question. So I go to Mark and I'm going to ask you, there is a lot of talk about financial giants that are becoming ethical from the point of view of green investments, but how much finance is actually sensitive to the environmental, how much finance is actually sensitive to environmental problem, and may there be a mechanism that make them truly accountable?
Let's see. I mean, I'd like to comment one comment on the last comment, which I thought was so insightful. I do think that global energy prices, which are not my business, they have been your business. So therefore, what the hell do I know? But I'll make a comment anyway, I guess. I look at it and say, we should assume this transition will disrupt global energy prices in a way that they have historically not been disrupted. So supply shocks take place, you get disrupted. But now we have a transition. If that disruption takes place, then we run the risk that the green movement becomes the anti-green movement becomes a populist movement, which is catastrophic in my view. So what will happen then is Democrats, I'm a Democrat, Democrats will say 5.5 million barrels leaving the United States. No, they stay here. Regs go up. Republicans will say drill more. Okay, like that's always their answer in general. So I think you really want to think about $200 a barrel oil is, I think, quite catastrophic for that general direction. You get an R president and we're out of the climate business. Okay, so we have to really imagine that. So that means that governments, the West, the United States, the West, and our allies who are energy producers need to think about, we're going to get disruptions, what the hell do we do about it? And have a real plan for if we disrupt above a certain level, we act this way. I really, signals like that to the market will mean the market will normalize and you'll have a lever against the Russians and the Saudis if they decide to raise price. So on the question of how ethical, that's a wonderful question. How ethical are financial institutions or something like that? That's a tough one. I mean, I think that the biggest financial institutions in the planet, in the United States, let's say, I really think have now gotten it into the CEO's heads for a variety of reasons that that your CO2 should not destroy my capitalism. Your producing CO2 is going to disrupt the entire business of business in a profound way. It's already started. We make a lot of money at 65 degrees Fahrenheit. We do not make a lot of money when Portland is 117 degrees. And we do not make a lot of money. The United States today is facing around 220,000 people at our southern border. A month, 220. How many did Obama face at his peak? Peak month, 60,000. 60,000, 200,000, okay? We haven't seen anything yet. That is not good for business, okay? And the most intelligent financiers are looking at that saying, whether it's Jamie Dimon or Brian Moynihan or you name the person, this is a big problem. Let's fix this, okay? What do we do? They now believe that. They really, I believe they now believe that, okay? What do they do about it? The United States government needs to, as much as possible, require absolute transparency around carbon all the way through the supply chain. We can't do, unfortunately, the SEC does not have the same power that the Europeans have. Europeans have a triple way of thinking about this, which includes social goods. The SEC does not have that. Anyway, I could keep going, but I think there's a lot of stuff that the United States government currently is looking to do and could do, which would push forward capital's movement toward net zero.
Could I just make a very quick addition to that?
Yes.
This is something I say to people frequently. Thank you, Mark. That was excellent. There is no SEC for carbon.
Yeah.
Doesn't exist. There's no regulatory body that manages this. The EPA measures stuff at the tailpipe, but it isn't even regulated, it just measures it. We're going to need a whole systemic reimagining of this if we're going to do this well.
Yeah, I mean, I think the logical place is for the SEC, the Fed, and the EPA, the combined skills of each of these institutions, a little bit of commerce maybe, have the capacity to do what you just described. If you say we need a new entity, the United States has proven incapable of producing new entities in the last 40 years, post-World War II, in a way that moves things, nor has the world produced new entities, really. So I think you want to try to use the existing infrastructure and then augment it.
I have a very quick final question for you, Mark, and then we move to the audience questions. How these new green trends in finance can help shift company strategies?
Could you say that again? I'm sorry.
How these new green trends in finance can help to shift company strategies?
Exxon spends $18 billion a year in CapEx. How much does it spend on E&P versus what Marco said is crucial? His number 3 was CCS. Okay, how much is on carbon capture of that 18 billion? So that's a modest example of a shift. JP Morgan says, okay, there are 6 core industries that we lend into that we want to understand all the way through the supply chain. Auto, for example, all the way through the supply chain. How do we make it net zero? Amazon says all the way through. Amazon is saying, if you go to Whole Foods right now and you see a product that's an Amazon private label product, they want to understand all the way through the supply chain of the private label product, whether it's soap or it's cereal, what is the emissions? The emissions by 2040, needs to be 0. If it's Unilever product that you're looking at, Amazon is saying that's Unilever's problem, not my problem. But those are examples of how it shifts.
Thank you so much. Now let me open up the floor for some questions from the public. I have the first one for Marco and Snam. So why it is taking so long to regulate hydrogen in Europe, like natural gas and electric transition networks with regulated returns? And would regulations expedite the hydrogen revolution?
So the European Commission, I had a conference call with Commissioner Breton this morning, is working really hard. By the mid of December, in a few days, we hope to get a draft of the new gas and hydrogen package. What they need to do is to loosen up the regulation that was really built around the unbundling, to separate the asset owners from the molecule transporters. It was really an effort to try to break up the oligopoly of the few suppliers sending gas into Europe. I would take the opportunity to comment for a second on the high energy costs, because we need to really separate oil and gas. Oil is a global issue. The price of oil is the same everywhere. When it comes to natural gas, Europe and China are competing for very few LNG cargoes that are, because the way the market is structured, they're driving up all the energy costs in Europe. That's really having the concern that Mark raised in creating a lot of populism, a lot of anti-green because of the high gas prices. And gas is, there's even less elasticity than gasoline because it's just about heating the homes, especially in places like Scotland. So China's doing what we want it to do, which is getting out of coal in their homes onto gas to reduce coal. So we can't complain about that. What Europe should do and what we want to do in Europe and what we want China to do is to build more gas storage, because no one really wants natural gas in the summer and there's no consumption in the southern hemisphere. And so the demand is all concentrated in places where it's winter at the same time, and demand in the winter is 5 times higher than in the summer. So we need to build massive new storage, like we built the SPRs after the war and after the 73 crisis. Huge new natural gas storages to really make China and Europe stop competing for LNG. The good news is we announced a day before yesterday that, and I think this is the first time it was done, we can store 100% hydrogen in the natural gas storage. So you're also building the future proof energy infrastructure that comes in the form of storage. So that's an answer there. And my final point, I'd like to make a proposal to Julia, maybe to Mark. Snam would be interested to consider sponsoring a chair in a developing country with Colombia. I mean, it could be a project development or a project finance or maybe both, but we'd like to sit down after this I heard what you both said. I think it makes sense. You accept. Good. Done.
It's a beautiful vision. Thank you.
So our time is running out, but let me ask a very final question from the audience. For which of you want to pick it up? Can the renewable energy and anticipated cost decline in green hydrogen be achieved without significant government subsidy?
I'll take the first bite at that. No, it cannot. We are thankfully in an era of great energy abundance. Renewable energy is everywhere and it's cheap and the costs are coming down. That said, it is extremely difficult to align the markets to get people to invest money in the short term. And the example I'll come to is the one that Marco pointed out. The Earthshot agenda for the Department of Energy is an excellent one. Really, it really is. It's $1 per kilogram. Even at $1 per kilogram, that is 3 times more expensive than natural gas in the United States, in terms of energy content, in terms of energy services. And that's okay, because we're now doing the incentives. We've got the $8 billion of hydrogen hubs. We've got hydrogen production tax credits that are being debated even as we speak in the Build Back Better plan. And the private capital wants to move into this. They just need to lower their risk a little bit. And that's where the incentives come in. And the incentives are not one person's incentives, another person's subsidy, but these are not dark words. It is simply saying we're going to pay a little bit to get the thing we want. The thing we want is clean. We have always paid a little bit for clean. That's okay.
Thank you. Someone else want to add something? No? So thank you again to our speakers for joining us today. Thank you to those in our live audience and to those joining us virtually. As we mentioned, the full video recording of this event will be available on the Center on Global Energy Policy's website in a few days. The Center's next event, Wind Energy, How Did We Get Here and What Next, will be held Thursday, December the 2nd at noon Eastern Time. For a full calendar of upcoming events, visit the Center on Global Energy Policy online. We hope you enjoy the rest of your day, and we look forward to seeing you soon. Thank you again for listening to us.